Welcome, welcome. All right. Next topic here is deeds, and we need to know the definition of a few deeds. There are several deeds that will always be listed in real estate books all over the place, but these three we want to know the definitions for. And there's a fourth one, which I'll mention, and you can look those up as well. All right. Number one, the general warranty deed. This includes warranties or guarantees from the seller that they have clear title to the property and that it's free from any encumbrances or defects, whether they arose during the ownership or before. So the general warranty deed affords the buyer the most protection available for a deed. It covers everything. It predates the owner's title. And if anything were to happen even before the owner took ownership, then the seller of this property signing this deed, the general warranty deed, is basically saying that it's covered by me no matter what. I will defend all claims while I owned it and prior to my ownership. The general warranty deed offers the maximum protection to the grantee. So test questions here might be, a grantee is suing a grantor for a title defect of some kind, and the grantee prevails. Which type of deed might the deed have been? Something like that. And that would be general warranty deed. So you just want to be able to say, hey, general warranty deed has the most power out there. The next one is the special warranty deed, used to transfer property ownership in which the seller guarantees to defend title against any claims or defects that arose during their ownership, but not before. So the special warranty deed is really just saying anything that happened from the day that I bought it to the day that you're buying it, I'll take care of in terms of defending. Anything that happened prior to my ownership, I've got no say there, and I'm not going to defend that. So that's the special warranty deed. And then there's something known as a quitclaim deed. This one allows party, the grantor, to assign ownership to the grantee or another party without stating the nature of the grantor's interests or rights, and while making no warranties. And many times we'll use the quitclaim deed to cure clouds or defects on title. All right, check out those definitions, work on those. You will definitely see deeds being referenced on real estate examinations. And the fourth and final one, by the way, that you might just want to know a little bit about is the bargain and sale deed. Check out that definition in our text, and you will see that these four deeds are the standard deeds. General warranty and special warranty are the standard deeds of conveyance across the United States. And then we see different states call them different things, but at the end of the day, it's all about the powers of those two particular deeds. Let's overview the closing process. We'll go through several things, and then I will pull out some of the things that may be test territory and will help you as you're studying. All right, let's get into it. So the first thing is let's just overview some of the key aspects of the closing process. Number one, the closing date. This is the pre-agreed date on which the closing will occur. It is specified in the purchase contract. And sometimes we call this purchase contract the purchase and sales agreement. The next one, closing agent, is a neutral third party, often an escrow or title company, that acts as the closing agent to facilitate the closing process and ensure that all documents and funds are handled correctly. Closing agent's a vocab phrase, and many times you'll see it. Sometimes in different parts of the country, they might refer to this as an escrow agent as well. Title search is the next one. Before closing, a title search is conducted to examine the property's title history and ensure that no outstanding claims or issues that could affect the title transfer exist. And a title search is one of those vocab phrases that you definitely want to know about as you're preparing for the exam. So know this one. This is a good one. Title search. Okay. All right. Title insurance is another big one for the exam. Many buyers purchase title insurance to protect against any future title defects or claims that might arise. In some states, the seller is required to purchase title insurance to guarantee their portion of ownership as they're signing title over in case there's an issue. So title insurance is another important vocab phrase, and you need to know a little bit about title insurance. Definitely review your materials. HUD-1 settlement statement. This document provides a detailed breakdown of all financial transactions related to the closing, including closing costs, prorated taxes, and adjustments between the buyer and the seller. For sure, you want to know about closing costs and prorations and these types of things, and they show up on some closing documents. Now, there is a rule called the TRID rule that you'll learn about later, and that rule actually has a closing disclosure which goes through the final numbers, but also there's this thing called a HUD-1 settlement statement, and it's for sellers, so you can look at the final numbers as you need and see fit. Continuing on, closing costs. These are fees associated with the closing process, which may include things like attorney's fees, title insurance premiums, recording fees, and more. Escrow funds and earnest money. These are deposits made by the buyer when the offer is accepted, which is held in a special account known as an escrow account until closing and is applied towards the purchase price. Prorations, definitely on the examination. You want to know these mathematically as well. These are adjustments made for the property expenses like taxes and utility bills, which are divided between the buyer and the seller based on closing dates. The deed, definitely on the exam. The deed is the legal document that transfers ownership of the property from the seller, the grantor, to the buyer, the grantee. Important note here, the deed is like a receipt. So remember, the bill of sale or the receipt is to personal property as the deed is to real property. It's the receipt. And then we have mortgage documents. If financing is involved, then the buyer signs various mortgage-related documents, including things like promissory notes and the mortgage or deed of trust, which is the security instrument itself. And again, mortgages are definitely on the exam. You want to study those, some vocab phrases, finance, all of those things. We looked at those in a different module, and you want to make sure you review those. All right, awesome. You are doing fantastic. We will see you in the next one. All right, we definitely need to know the difference between a foreclosure and a short sale. So let's detail the two of these right now and kind of break it down so you understand the difference. And if I can think of anything else that might come up here on the exam, I'm going to certainly let you know. All right, number one, what is a foreclosure? It occurs when a homeowner defaults on their mortgage payments, leading the lender to seize and sell the property to recover the outstanding debt. Process is initiated by the lender and typically involves a legal proceeding, resulting in the homeowner losing ownership rights to the property. There are two types of foreclosures, by the way. There's a strict foreclosure and there's a judicial foreclosure, non-judicial and a judicial foreclosure, right? So you're going to learn about those in different sections of your learning. And then you can negatively impact the homeowner's credit score and results in the loss of equity in the property. So foreclosures are a little bit of a tough situation, and if you compare them to a short sale, there's a little bit more that the defaulting homeowner can walk away with potentially on a short sale. Let's take a look at this. All right, number one, a short sale occurs when a homeowner sells their property for less than the amount owed on the mortgage with the lender's approval. Now, if you owe $500,000 and the house is worth $700,000, to get a short sale, you might have to sell it for less than $500,000. So in other words, the negative here, like a foreclosure, equity's at risk, and the seller might lose a bunch of equity. Typically initiated by the homeowner as a way to avoid foreclosure and mitigate some of their credit damage. They might be able to walk away and still preserve potentially their credit rating, which is important if they want to continue to move forward beyond it. Foreclosures typically last or sit on a credit report for at least 3 years. There has to be some distance before the big secondary mortgage market players will consider lending or securitizing a loan from a borrower that underwent a foreclosure. And the next one here is requires negotiation with the lender to accept a lower payoff amount and may involve a lengthy approval process. I can tell you that lenders absolutely drag on the short sale process. It is not in their best interest to take less than they were promised. And if there is equity in the property, they would much probably rather prefer the foreclosure, as in many instances, that's a judicial process or a non-judicial process that's been predefined in the mortgage documents in itself. So there could be a power of sale clause, which is another vocab phrase that you want to know. So you kind of want to know a few of those phrases, and these are the two types of default remediations that you many times will see on real estate examinations. I'll see you in the next one.